Hello and welcome to Budgets. A budget is a financial plan for a business. A budget is prepared in advance, usually for a period of up to 12 months. Each section of a business has its own budget. You can have a sales budget, production budget, purchases budget, a labour budget, and a cash budget. Now, the managers and supervisors, they are responsible for the budgets. They are known as budget holders. The master budget is composed from the individual budgets of the business. And the master budget comprises the forecast income statement and the forecast statement of financial position. Right, budgetary control. Budgetary control is the process of using budgets to monitor actual results against budgeted figures. So you have your budgeted figures, then you get your actual figures, you monitor and compare the budget and actual figures, and then you have control and you can take action. Benefits of budgetary control. Plan for future activities, coordinate with master budget, control of the business, communication with the business, motivation of staff, evaluation of performance, decision making for production, sales, and costs. Limitations of budgetary control. Costs of preparing a budget may exceed the benefits. The information may not be accurate. Staff may be demotivated. Budgets may be set too easy, and budgets may restrict activities. Right, types of budgets. So the sales budget. What can a business expect to sell in the coming months and how much money will be received? Production budget. How can a business make or supply all the items which it plans to sell? Purchase budget. What does the business need to buy to make or supply the goods it plans to sell and at what cost? Cash budget. What money will be flowing in and out of the business's bank account? Will an overdraft be required? And the master budget is a summary of all the budgets to provide a budgeted income statement and a statement of financial position. Example now, I've got two examples for you now. So production budget number 1. ABC Limited produces bookcases. The following information has been collected. Demand is expected to be 1,000 units in month 1. This should reduce by 10% in month 2 and 5% per month based on the previous month's demand. The stock at the end of each month is to be maintained at the level of 20% of the following month's sales, but should not exceed 250 bookcases due to storage constraints. The stock at the start of month 1 is 100 bookcases. You've got to produce the production budget for the next 4 months, round up to the nearest whole bookcase. So here's a solution. I've got a template for you. So first of all, we've got the sales in the first row. Now it says in the question, demand is expected to be 1,000 sales in month 1. So that's 1,000 sales. This should reduce by 10% in month 2. So reduce that by 10%. It's going to be 90% of that. We get 900. Then by 5% in month 3. So that's going to be that divided times 0.95. Then in month 4, again, it's going to reduce by 5%, so it's going to be 95% of that. And it says round to the nearest bookcase, so it's going to be 813. Sorry, 813. And the opening stock. Stock at the start of month 1 is 100 bookcases. Minus 100. The stock at the end of each month is maintained at a level of 20% of the following month's sales. So that's going to equal the 900 times 0.2. So the production then is going to be the combination of 1,000, the number of units sold, less the 100 we had at the beginning, plus 180 at the end. So we'd actually have to produce 1,080 units. Now, month 2, the opening stock will be the previous month's closing stock. And the closing stock will be 20% of the next month's sales. That's 180. Check that. So the next month's sales are 155 times 0.2, and we get 171. So the production then from month 2 would be 891 units. Month 3, the opening stock will be last month's closing stock. So this will be negative 171. The closing stock will be 20% of the following month's sales. $163. The opening stock of month 4 with the previous month's closing stock. And we want the closing stock now. All right, so to get the closing stock, we need to know month 5's now. So month 5, a little bit on the right. The size is going to be the previous month's. It's gone down by 5% times 0.95. It will be 773 units. So that means my closing stock then for month 4 will be 773 times 0.2. So that'll be 155 units. So the production from month 4 will be 805. Now I just highlighted for you here, to get the production, you have your sales, your extra opening stock, plus your closing stock, that equals the production for you. Production budget number 2. So let's see what we've got here. AQA Limited makes solar panels. The production manager gives you the following information in order to produce a production budget for the 6 months of January to June. Demand is expected to be 2,000 panels in January. In February, this should increase by 20%. Then from March, April, and May, should increase by 5% each month based on the demand for the previous month. In June and July, demand is set to be 2,200 panels each month. The inventory to be held at the end of the month is to be maintained at a level of 25% of the following month's sales, but the maximum capacity of the warehouse is 650 panels. The inventory at the start of January is 275 panels. Prepare a production budget for the month of January to June. When necessary, round up to the nearest whole solar panel. So here we are. I've got another template for you. So the sales then, let's see what we've got for January then. 2,000 panels in January, so that's 2,000. In February, it increases by 20%. So it's 2,000 times 1.2. In March, April and May, increases by 5% each month. So it's going to be 2,400 times 1.05. April will be 2,520 times 1.05. May, yeah, it's increased again by 5%. So it's 2,646 times times 1.05. And in June it says they might expect to be 2,200 panels per month. So 2,200 panels per month. Now that's over here. I'm going to sort of make a note for July in case I need it. It's sort of going to be 2,200 panels a month as well. So let's sort down July there. Now, opening inventory. We're told at the start of January it's 275 panels. So take away 275 panels. We've got them already. Closing inventory. The inventory maintain a level of 25% of the full month sales, but the maximum capacity of the warehouse is 650 panels. Okay, so let's see what we got here then. So in January, closing inventory is going to be 2,400 times 25%. That's okay. And the production then will be the 2,000 we sell, less what we started with 275 plus what we finished with 600. That's going to give us 2,325 units. So February, the opening inventory will be last month's closing inventory. The closing inventory will be 25% of the following month's sales. And then the production will be 2,430. March, opening inventory will be last month's closing inventory. Closing inventory will be next month's sales times 0.25. And that comes to 662. Right, you need to take care now. Notice this. The maximum capacity is 650. So they can't hold 662. You've got to reduce that to 650. And the production is the three of them combined together. April, your opening inventory will last month's closing inventory. So it's going to be the 650. And we're going to reduce that. Closing inventory will be the full amount sales times 25%. Again, it's gone above 650, it's 695, but they can't hold more than 650. So it can only be 650. And the production for the month then will be 2,646. Right, May now. The opening inventory will be last month's closing inventory. Closing inventory will be 25% of the following month's units. Are we back below 650, so we're okay. And the production will be 2678. Right, June. Closing inventory will be opening inventory will last month's closing inventory. Closing inventory will be 25% of the next month's sales. And production then will be for June 2,200 units. So remember, the blue bit that I've highlighted is the maximum capacity of the warehouse. And in this question, it's going to be 650 panels. Right, benefits of a production budget. The use of a production budget enables a business to identify the production capacity available, schedule resources effectively, for example, cash, materials, and labour, meet sales demand, and make best use of spare capacity. Right, now onto the other budget for today, purchases budget. The following budget information is available for product Y for the month of June. The quantity of material per unit for product Y is 5 kilograms, that's per unit. The budgeted sales of product Y is 3,000 units. The decrease in the inventory of the material for the month is 2,000 kilograms. And the increase in the finished goods inventory of product Y is 300 units. How many kilograms of material will be purchased during June? So here I put together a little small template for us. Now sales, to work out the sales going to be sold, it's going to be 3,000 units and each unit requires 5 kilograms. So that's going to be 3,000 units times 5, giving us 15,000 units. Now material used, a decrease in the inventory, so it's going to be 2,000 kilograms. So that's already in your inventory, already had it. Increase in finished goods. So increase in finished goods is 300 units, and it's 5 kilograms per unit. So 300 times 5 kilograms, that means we have to have an extra 1,500 kilograms. So the purchase of materials then for June will be the three combined together, and that'll be 14,500 kilograms.